So, since we talked about the 5 types of markets, I thought it would be a fitting place to jump over here in Van Tharp to talking about developing a trading system that fits each market type you plan to trade. So we're going to talk about that for a little bit here. I'm probably not going to get through all of it. I'll probably do about 15 minutes, and then just before Scott comes back, we'll hop over to the Bitcoin chart and do a fun exercise. I want to start trying to do chart-based exercises with you guys just to practice getting in the right psychology, what you would do, kind of a problem-solving exercise. So after this, we're going to go look at the Bitcoin chart in the past. I've hidden some of the labels. You're generally not going to know where we are, but you're going to have to try and make some decisions about what you would do if this is what you saw on the Bitcoin chart. So that should be fun. But for now, let's skip down here and start talking about designing a trading system that fits you. Now, we haven't spent a whole lot of time talking about exactly how you might design a trading system. There's a bit of it in the source code. Scott's talked about it before, but as far as the foundations course goes, and this room's kind of more tied to the foundations room, I want to take the next couple of times that we are together to talk specifically about how you go about building a trading system. So at the beginning of this section, you can see that Van Tharp talks about Jack Schwager's conclusion after writing the first 2 Market Wizard books. So we've read those books together. He talks about all great traders develop systems that fit who they are. And then he gives us some criteria. So he says, you need to know who you are. How can you design something that fits you if you don't know who you are? Then once you know who you are, you can determine your objectives and design a system. What are your beliefs about the big picture? To what extent must your system be able to fit the beliefs? For example, if you believe the US dollar is doomed to collapse over the next 5 to 10 years, how funny is that? How will that affect your thoughts about developing a trading system? Then he says you can trade only your beliefs about the market, so you need to understand what those beliefs are. What specifically do you believe about the market, and how does that give you an edge? When you understand these criteria, you can design a system with which you're comfortable. So he says, let's take a look at an example. Suppose you believe that markets are not really random. There are big trends that don't fit the price movements you'd expect in random markets. You perhaps believe the best way to make money in the markets is to find and capitalize on those trends. Okay, so we can all relate to this little hypothetical here. If this was your belief, do you think you could do the following? Could you buy things that were out of favor, things nobody likes? Probably not, because that doesn't really fit your belief that you believes that you gives you an edge. Would you sell high and buy low the way a band trader is likely to do? Probably not either, because that's a very different mentality. He says he could give us lots of examples, but he talks about moving forward, you must understand the various parts of a system and the beliefs that you have about those parts. Now, some of you that have read the other Van Tharp book, Trading Beyond the Matrix, he gets in this idea about your different parts and having an argument with them, and he gets a little out there, and for some people that's a little bit too fluff and not enough technical. But in this section, if you kind of get a little further down in here, he gets into some really important stuff. I'm going to read this number 7 and 8, and then we're going to go to the really important stuff. So he says, you have to ask yourself, what criteria must my system meet for me to be able to trade it comfortably? And I've talked to you all about comfort level. If you're in a trade and you feel uncomfortable, you need to do one of 2 things. You either need to scale it back until you're comfortable, or you need to get out and replan your trade. So he says, I could give you lots of suggestions, but it's still a matter of personal comfort and big part of developing a system that fits you. Here's some criteria. Does the system fit my beliefs? Do I really understand how the system works? Do I understand how the system will perform under various market types? That is, does your system involve malleable parts that are set to the different conditions of different market types? Do you trust your initial testing of the system? Have you done any testing? Do I feel good about trading it? Do you feel confident you can trade it easily in your schedule without making mistakes? That last one's a big one. I think people get so wrapped up in finding a system, getting into a position, and having an exit plan, even when they're trying to be smart and plan their exits, they stop and forget to think about, do they feel confident that they can easily trade their plan, fitting into their schedule without mistakes? So a lot of people might think they have a good setup. Maybe you get used to pulling fibs, and then you're in 5 different trades and you get sick. And I'm using that as an example. not because of what's going on in the world, but because it happens. Even without a pandemic spread, people get sick all the time. And if you don't have a plan, you don't have your stop losses in place, you don't have contingencies for what you're going to do if you're unable to make it to the computer for one reason or another, you're probably not going to feel very comfortable when you get sick. Right? So it's not just about planning a comfortable entry. It's about planning how to be comfortable through the duration of the trade, through the exit of the trade, and should the unexpected black swan event, personal or global, hit during your trade. If all of those bases are covered, you're going to feel pretty confident about following your rules in your trading system. Okay, now he talks about different trading concepts. Now, we've kind of alluded to some of these before in this room and some of our other, in the lab and some of our posts on Facebook, but he does a really good job here of defining these different types of trading systems or ideas. He says there's many different types of traders, and one way to classify them is by the basic concept they trade. Some of these concepts are diametrically opposed, but you can trade any of them if you believe in it enough and practice low-risk ideas. Listen to that again. You can trade any of them if you believe it enough and practice low-risk ideas. So none of these is necessarily better than the other at a fundamental level, but some of these will fit you as an individual better than others at a very basic level. So the first one is trend following. The basic idea here is that you buy what's clearly going up and sell when it stops going up. Okay. Similarly, you sell short what's clearly going down and you buy it back when it stops going down. So trend following is very simple. Buy low, sell high, buy low. The next one is fundamental analysis. The basic idea here is based on the supply-demand concept in economics. You need to analyze the market to find out where demand may exist and buy there, ideally before it occurs. When you think the price is high enough, demand may drop off, you sell. So this is kind of the Warren Buffett method. You're looking for things that are good at a business project level, but they're not necessarily things that you want to get in or out of quickly per se. So after that, you have value trading. You buy things that are way undervalued, assuming one day the market will catch up to their value. So I think in crypto, a lot of people are value traders. They're the ones that are running around looking for projects that have intrinsic value based on a utility, but which are underpriced at the time. Okay. Now the problem with value trading is, as he points out, there's thousands of ways to value stocks. Do you value its algorithm? Do you value its security? Thinking of crypto examples, do you value its supply structure, its reward structure? Do you value its networkability, its dApps programmability? All of those things to different traders have different levels of value. So if you decide you like value trading, your job's to find one of the more useful methods. Then there's band trading. So you're trading within Bollinger Bands. I won't say that wrong. Or even just like channels. So he says instruments trade in bands. You buy something when it touches, crosses, or gets close to the lower band. Maybe you're moving averages. Could be your upper and lower band that you're trading within. You have seasonal tendencies. Scott's talked about these before, knowing that the big boys go away for the summer and come back in the fall. Christmas rally, knowing about those types of events. There's spreading, so you're trading the spread. It says it's professional traders really creating long and short positions with potential to move, but with a lower risk profile. Arbitrage, again, primarily by professionals. In crypto, we see arbitrage a lot on bots. Then there's intermarket analysis. So this might be something like watching the price of gold against the price of something different, the yen or something. So he says it's not a simple relationship. Thus, gold may be related to the price of oil, silver, the dollar, a number of other currencies, and they change their relationships over time. So you have to understand how to identify when those relationships change and how they work together or against each other. And then finally, the more fun of the bunch, in my opinion, there's an order to the universe. Here there are a number of sub-concepts, including waves of human emotion, Elliott waves, physical events that may influence human behavior, coronaviruses, and a mathematical order to the universe, Fibonacci's. All these concepts can be traded if they fit you and you use appropriate low-risk techniques. So he says all these concepts describe the setups one might have for entry. Setups are a small part of trading, but because people think picking the right investment is so important, these types of concepts were developed. Trading styles actually are named after the setups. And then here's the big piece of wisdom, light bulb, eureka, aha. Setups are not as important as you think. So he goes into great detail into this concept in several different of his books. He talks about Monte Carlo analysis that run thousands of simulations, random entry systems, and they come to the conclusion after thousands and thousands of runs that the entries matter very little, and what matters is your exit strategy. Because once you're in the market, you can't change your entry anymore, and what really is going to matter is if you're able to cut your losses short on individual trades and allow your trades time to develop with a trend in the right direction to make you money. So entries, and especially in markets that are in the big picture kind of always going up, although they got to turn at some point, the entry doesn't matter. Even if you get in at the top, if you have a good risk parameter, if you set your 2% rule, you have your stop loss in place, even if you had bought Bitcoin at 19,000, you would have been stopped out. You would have seen the huge red candles, the crazy bearish engulfing candles, the breaking of moving averages, the hype at the top of it, the volatility come in like we're about to see on the equities, and you would have said, that's not a safe play. Now I need to wait. So I think it's kind of this logical fallacy that you have to get in at the right point, because you really don't. You just have to get in with a good plan and a good strategy so you can get out of the way if you got in right as the trend is moving against you, because that's always a possibility. Be ready for that possibility and accept it. Don't fight it. Don't argue with the market. Just be ready to be proven wrong, accept it, and move on to the next one. No emotion. Not a big deal. Here he talks a little bit about this idea of entering the market. He says that Tom Basso and him were giving systems workshops. They were emphasizing the importance of psychology and exits and position sizing. And someone in the workshop said, I suppose you could make money with just a random entry. They hadn't thought about that before, but they went home and tested it. And this is what I was talking about. And sure enough, they made money with random entries. He says people are brainwashed to think that success is picking the right stock or coin. Those of you that are spending hours trying to find the perfect coin that nobody's noticed, in my opinion, you're wasting your time. Unless you are looking for the next Google and you want to buy a turtle position for a very long-term hold and you don't care what the market does, and that's the only reason you're doing that research, fine, great, go for it. But if you're spending 3-4 hours a day digging through project notes, digging through announcement forums and GitHubs, trying to figure out whether or not you should enter a trade, I think you have a little bit of a logical miscommunication in what you're trying to accomplish. If your goal is a short-term trade, you don't need to do that long-term project analysis if you've got the technical analysis to support your trade and you've got good risk management. That's really what it's about for trading. For investing, yes, dig into your fundamentals. For trading, look at your chart, make decisions based on your beliefs about the market, what type of market you're in, and what types of parameters you can enter to give yourself a good risk to reward opportunity. So he goes on talking about the results of the random entry system. He talks some more about the source of the myth of stock selection. Then here's where it really gets important to our context of having trading plans that fit the type of market. Exits are the key to making money. He says, how can your exits help you catch a strong trend? In a random entry system, when you exit, you'll enter back into a trade again and lose another $100 in slippage and commissions. Thus, you want your initial exit to be large enough to make sure you don't exit very often. You want your initial exit to be large enough to make sure you don't exit very often. Another way of saying that is you want a wide stop initially. At the same time, you don't want to enter into a trend in the wrong direction, which would cause you to pile up huge losses. Thus, to make the random entry system work, I needed an initial stop big enough to keep me in the market while it was just making random noise movements or moving sideways. I chose to exit at 3 times the 20-day volatility or average true range. So If the average range on Bitcoin is $500 every day, he would exit at $1,500 loss from his entry. And then you'd have to fit into that parameter, what's your 2%, right? Now he's doing random entry, so he's not too worried about the TA of a good stop because the TA is not going to matter so much in that system. So he talks about going through it, talks about getting stopped out, and then that a tight stop produces a smaller risk, but it also means you're going to get stopped out more often. Now he talks about exiting a trade beyond the initial stop. When you design an exit for your system, one of the key things to consider is the purpose behind that exit. You might have 4 possible purposes: produce a loss but reduce the initial risk, maximize profits, keep you from giving back profit, or psychological reasons. So he says rather than cover them each individually, he focuses on one particular goal to show you how to use exits to meet the goal. This is a really important part. When you are going through your plans and you have an idea for a trade, think about what your goal for that trade is. So he says, let's say your goal is to follow a trend as long as it lasts. So your goal is to press your winner into the trend for as long as possible. But you want to have a wide initial stop so you won't get whipsawed once you get into the market. You don't want to get hit with that sparky, sparky, boom, boom. You also want to give the position plenty of room to move. And you want to capture as much of the profit as you can once you reach a 4-hour target. So to know these goals, you would have to be asking yourself questions like, what do I want to avoid after I enter? How violent or volatile is the market right now? How can I make sure I don't give back my profit? Bizarro says the recent Jankowski discourse and this Start discourse is in need of many reads. So good and crucial. Absolutely, Bizarro. I can't agree more. This is the 3rd time I've come back through here and I'm still finding things that I missed the first 2 times. So he says to meet your initial goal, you need a wide stop. Notice he is building his plan around his goals. He's not looking at the chart and trying to make his goals meet what he sees on the chart. Okay. That isn't to say that once you look at the chart, you can't adjust to compromise between the two. If you get a wide stop in there and it makes no sense because you need to, if you just moved it down a little bit further, you'd be underneath a really important support zone. Push it a little wider in crypto, start with a smaller initial position. There's nothing wrong with that. But your goal is to have a wide stop. So your plan should satisfy that goal and the chart has to kind of align with it or you adjust accordingly to the chart. He says it gives you plenty of room to make sure the random noise in the market won't take you out. Second, you want to give your position plenty of room to move as it's going up. All you have to do here is trail your 3 times volatility. So he uses a trailing stop because, again, his goal is to keep it wide. So as it moves in his favor, he pulls it up. Now in crypto, I don't like to use a trailing stop unless I'm close to my target. But in equities, you can use it a lot more frequently because generally the volatility is less. Third, he says, once you've reached 4 times risk, so if your risk was 20%, if you reach 4 times that, you don't want to give much profit back. Thus, you decide when your target is reached, you'll shrink your stop from 3 times the volatility. So if your stop was 20% wide and your position is small, if you get to the point where your position is 4 times what you lose from your stop. So let's make this very, very simple. Let's say you have $100 that you put on Bitcoin, 20% stop. So if you lose $20, you would be out. Well, if you gain 4 times that $20 or $80, you should be concerned about giving it back. So you decide when your target is reached, you'll shrink your stop from 3 times volatility to 1.5. So he pulls it up halfway. He says it's that simple. I think where people struggle in this regard is they want to get it perfect. They have a really hard time balancing their greed and how much they want to keep their profit with their desire to let their winner run further should it keep going, and so they want to give it a wider chance. So my suggestion to you is not to pick an arbitrary 50% or 70%, or I'm going to pull it up every time it goes $100, I'm going to pull it up 20 more. Really, really, really look at the chart and ask yourself, where would I be most comfortable pulling my stop up to, given where price action is now and where my target is at? Where would I be most comfortable? That's what you want to do for yourself. Give yourself a comfortable trade. So then he talks a little bit more about his stops and what the goal is behind them. And then he talks a little bit more about thinking in terms of risk and reward. I'm going to leave off there. We'll go into this a little bit more when I come back. I won't actually, I'm going to side note here, I won't be back Sunday. I'm having a procedure taken care of tomorrow, and so I'll be out Sunday. Mo will be here with you guys. But I want to do one more thing before I hand it back to Scott, my little exercise. And Bizarro says, one of the biggest issues in every facet of entry and exit. I've gotten to a point where I'm addressing this by using a strict R factor and RR system that is a my must use for any trade, or I can't enter. Perfection. That is something that I think is a really good example of, you know, that for you, that is a perfect feeling. You don't have to worry. You know you have a strict rule because that's what you need for your individual preference, and you can follow it comfortably without any issue. That's what you're really shooting for. Whether or not, as an individual, it means using that strict R to R system, or whether it means as an individual using a trailing stop. That's what's important. Perfection is my biggest issue. Okay, yep, I can relate to that as a teacher. So before I give it back to you, Scott, I've got one little exercise to do here. Let's see if I can trick some of you all out. And I got to get my chart adjusted just right so I can see it and see the chat. Okay, so we are looking at Bitcoin USD. We're at $8,000. Now I'm going to try to leave the cursor off because I kind of gave away the year a little bit there, but I darkened the time frame out here so that you can't really see it. If this was the chart you were looking at, here's the question I have for you. Do you buy Bitcoin at $8,000 if this is the chart you're looking at? Take a moment, think about it. Take a moment and think about it. Bizarro says no. And I know why you're saying no, Bizarro. You're saying no because it looks quite extended. We're heading up parabolic, and I don't want to buy something that high. Well, the volume is falling. Guys, sure. Volume is falling. So we're talking about this here. We got some falling volume. Yes, we do. Guy says it's a pull. Sure, this kind of, oop, let me get my arrows off here. It's kind of a little pull here, right? Kind of in this area. Why is it? Oh, I know why it's trying to do that, because I've got my end set to an arrow. There we go. 1 second here, y'all. So we've kind of got a pull in here, okay? So if we came in from the bottom of the pull, who's to say we don't go out the top of the pull? Right? And now if you're clever and you're looking down at the bottom at the date here, you're thinking, well, I know what comes next, but I wouldn't have known that back then. Well, if you start to think about what's going on here in terms of what type of market are we in, first of all, I notice this is when we're moving up, and I notice that volume, although kind of clunky, is kind of starting to head up a little bit with it. It's supporting that a little bit. I notice that as we get a pullback here, the selling increases, but what happens? We hit this moving average, huge volume. That's going to interest me in a second. I'm looking at how it's behaving with the moving averages. Notice it seems to be getting support from my moving averages. Okay, and if I really come back and pull in down here a little bit, it's never broken the red moving average once. Okay, so that's all something important to know. And if I zoom, give myself some more time here to really look at volume. Compared to this area where volume is low, I can see the trend over time is that it's starting to pick up. So that's kind of supporting this parabolic movement here. So what I'm going to try to figure out real quick is, if I was pondering whether or not I could get in, is this pull going to continue? What can I look for, and what can I kind of ask myself? Well, I've got this nice turnaround move here with this huge volume. That's important for me. I'm looking for places where a big position's entering in the direction of the move to sustain the trend. That to me says some big money got in. It came in, it went through a pole, which is a sideways move, and there was buying going into it. And this is where we pulled off and we got our first selling. So I'm going to go right to the top of this wick, and I'm going to see what happens. Remember, I can't see what's going on in the future here. I'm just looking at what my volume's doing that's supporting this potential quote unquote secure trend. What do we see? Well, we see is Bitcoin going to 27,000. Maybe I'm going to get brave and take a position. Now, if those of you who've never seen this replay tool up here, this is a really handy thing. You can click replay and go back in time, and then you can give yourself the chance to watch what happens. So let's watch the daily candles come in. Here they're coming in. Okay, I'm getting a few hits. Something's happening. Okay. Now, if I entered there, I'm happy right now. I'm really happy, and I'm hoping it's going to keep going. I see a couple of fib hits. Some stuff's happening. So let's let it keep going. We got a pullback, some kind of a reaction there. I'm not sure if my fib's on quite right, though, because they kind of reacted in the middle of a fib area. So maybe I'm going to try and play with it. And maybe I'm going to come back to the pullback on here and think, okay, maybe this is actually, they were coming to a 618, and maybe I didn't need to use the wick here. Now, as this is developing, I'm moving my fibs to match the price action a little bit to kind of get an idea. Should I get out? Do I keep going? We get some pullback here. Oof, that's getting scary now. Because now, if I entered up here, if I enter down here, sorry, try to get my shift key working with me here. I'm just gonna do it right, there we go. I was up quite a bit in a short amount of time. This is gonna get my, if I don't have psychology prepared, my head is getting blistered right now. I think it's going to 1,000,000. But when this happened, what I should have had in place was a stop loss initially that was somewhere down here. They went to the pull, broke to the upside, so I should have moved it here. They went and took off, came back, improved this area. So somewhere in here, I should have pulled it up under here because here's a square up anyway. Now, as they came up, if I'd have had my stop loss here and they'd have come out and got me out, I might have gotten upset because I might have given back about 30% from the top of that move. But in the context of this, really, I gave up almost 50, 60% of my total move, but I'm still in the green. I still took away almost a double of my money. If I was smart, I would stop and watch what happens. I wouldn't jump right back in and try and revenge trade. Maybe I stopped out partially into profit. Maybe I took some gains on the way, but I should be watching what's happening. And as this starts to play out, that right there should be my sign that no, I really should have been paying attention here. If I'm an expert trader, I'm watching this red leg and I'm thinking, ooh, that looks more like we probably did something like that. By the time I got there, I should have had my parameters adjusted. And I don't even know if this is the best leg to pull off of. I'm just going off of volume. I would have been using the 4-hour. I'm trying to do a very quick 10-minute overview with you guys without spending too much time on it. But this is the kind of process that you should be going through when you're walking into something blind. You have no idea what's happening. Should I get in or not is ultimately the question you're asking yourself. And remember, we asked ourselves that question here. We decided to take a chance. It could have paid off, but what really goes wrong for people in the beginning is when they go from here up to here, they lose their mind. They're up 200%. They mortgage their house. They double down up here. They put every bit of money they can because look how much money they just made so quickly, so easily. They're a genius. They're a stock picking genius. A crypto picking genius.
A crypto picking genius. Can y'all hear me?
And here comes the market to remind you just how dumb your money really is.